Hi, I'm Mijun from Mijun University. Let's begin today's Mijun for December 30th. Welcome to Mijun, who continues to uphold the fundamentals of investing in United States stocks as always. Today is already December 30th. Now, there are only 2 days left until 2025. I'm not sure how you all spent 2025, but that was the news story. Sometimes I think that our lives are a series of countless decisions and choices. As we live, we inevitably have to make various choices and decisions at different points, and I wonder if our lives are made up of all these choices and decisions we make. In that sense, in 2025, I made a very big decision. My family and I moved our residence to Malaysia together. It wasn't an easy decision. After making a choice and decision like this, in order for that choice and decision to lead to a successful result, I think it's really important to believe that your choice and decision were the best from the moment you made them and to fully support them. Now, in early 2026, you will have to make many decisions and choices again. Whatever plans you make and whatever decisions and choices you make, if you believe that those choices and decisions were the best and fully support them, I think you will probably be able to make the coming year of 2026 a successful and happy one. All right, then let's begin today's big news on December 30th, 2025. Earlier, I talked a bit about choices and decisions. When you invest in stocks, you have to make a lot of decisions and choices every single day. That's why it's hard to relax and feel at ease even for a moment. Yesterday, I sent out a broadcast titled Top 5 Stocks for 2026 selected by Topney. After watching this broadcast, one comment really caught my eye. There are some stocks that Topney has postponed until now that haven't gone up and have actually dropped. For example, Bitcoin, Ethereum, and small cap stocks haven't performed as well as large cap stocks. So that person said, I don't trust Topney, and I wish you wouldn't upload videos like Topney's. That's the kind of comment they left. But it's hard for Topney to get every stock and every trend right. What's important is whether the probability is high. In the case of Topney, back in 2020, when all investors were paralyzed by the fear of the pandemic and selling all their stocks, he was the only one recommending stocks. And it was the same in 2022. When the fear hit as if the bear market would last forever, only Topney insisted that we should buy stocks. And just as Topney claimed, the 2022 bear market actually ended a bit sooner than historical statistics suggested. So since this has happened many times before, just as Topney recently said, Bitcoin and Ethereum aren't performing well right now. So I think it's a problem to dismiss someone as incompetent or untrustworthy just because of this. If you look at the top 5 or top 10 analysts on Wall Street with the highest success rates, their win rates actually don't even reach 80%. Usually, even if you have just over a 70% win rate among the more than 8,000 analysts working on Wall Street, that's recognized as the best performance. That means if you recommend 10 stocks, 2 or 3 of them are bound to go down. You can think of us as top analysts as well. Me too, it's this Saturday. On January 3rd at 10 anti-meridian Korea time, I plan to reveal the 2026 United States stock top picks to you all. You shouldn't expect that all the stocks revealed at this time will go up. For example, when I revealed the top 5 stocks to watch in the second half of 2025, 4 of them went up, but 1 of them dropped sharply. 6 months later, Wixcom fell 33%. Looking at these results, you might think that I didn't predict very well. Personally, since all four stocks surged by 113, 73, 70 and 35%, I would like to say that I am satisfied with the results. And at the end of the live broadcast, Kim In-jung and I each picked a stock and announced our top picks, saying, "In my opinion, this stock is the best." In my case, I chose Peel Solar, and Kim In-jung picked Astara Labs at that time. As you can see, the returns of the two stocks are very similar, and both have recorded an increase of over 70%. So this time we plan to proceed in the same way. On Saturday, we will reveal our 2026 United States stock top picks. Among them, I will select one stock, and Chief Executive Officer Kim In-jung will select another. After 6 months, we will reveal whose stock achieved better returns. And for your reference, this message is the one I sent to Chief Executive Officer Kim In-jung this morning. Originally, I was going to select only 3 stocks, but it was too difficult to drop one, so this time I decided to announce 6 stocks. I will make the announcement today. So, Chief Executive Officer Kim In-jung will be providing a numerical analysis of the fundamentals for these 6 stocks. And then, out of the 6 stocks, I will pick one, and Chief Executive Officer Kim In-jung will also select his top pick, so we'll have a fun time choosing the best stock. We hope that many of you will participate in the Mijon Top Pick event taking place on January 3rd. Let's quickly review yesterday's United States stock market trends. First, look at the S&P 500 map. You can notice about 2 things. First, overall, the number of rising stocks was a bit higher than the number of falling stocks. And the red color is mostly concentrated in tech stocks. So yesterday, small cap stocks actually performed better than large cap stocks. You can see it that way. And the second characteristic is that whether it's red or green, overall the colors look dull. That means there weren't many stocks that surged or plunged sharply. You can see it that way. Only stocks like Palantir or Tesla have a slightly brighter red, while the rest of the stocks look quite dull overall. If you look here, Micron Technology went up by more than 3, and among the rising stocks, it boasts the brightest green. Actually, even if you look at the movements of various indicators, there aren't any indicators that have gone up or down significantly. Yesterday, most of the indices showed negatives, but it wasn't a sharp drop like 0.3, 0.5 or 0.4. It's the same when you look at the performance by sector yesterday. There were a few more sectors that fell, but the decline was very limited, and there weren't any sectors that showed a sharp increase either. As for market breadth, it widened a bit more compared to yesterday. In the short term, stocks with a good trend went up to 63.6, and in the long term, stocks with a good trend also rose to 61.6. So overall, stocks with a good trend are overwhelming those with a poor trend, which is a positive sign. As for the volatility index, it went up a bit compared to yesterday and is now at 14.2. Nevertheless, the fact that the VIX index has dropped below 15 is much lower than the historical average. So right now volatility is very weak, and you can see that the conditions are set for the stock market to gradually rise. The Fear and Greed Index dropped significantly from 55 to 49 yesterday, so the Fear and Greed Index has fallen more than expected. That means there's still a lot of fear, especially among tech stocks, particularly those benefiting from AI. That's why tech stocks aren't rising easily yet. There are still a lot of concerns and worries in the market. You can see this phenomenon by reviewing the United States top picks performance yesterday. The number of stocks that went up is very limited. Micron Technology showed the best momentum recently and went up 3.41% yesterday as well. Bitmain rose 0.81% for the first time in a while, AMD gained 0.29%, and Google increased 0.02%. Bitcoin is at 87,000, Cred Technology dropped slightly by 0.09%. Celestica was down 0.11% and Ethereum fell to 2,930. The exchange-traded fund-tracking Ethereum was up 0.35%, Versola was down 0.53%, Taiwan Semiconductor Manufacturing Company down 0.63%, and Meta down 0.69%. Overall, the declines were generally very small. At the end, you'll see Palantir was down 2.40% and Tesla dropped 3.27%, making them the stocks with the largest declines. I'll wrap it up here. Earlier, when we looked at the S&P 500 map, there weren't many stocks that had a sharp drop or a big surge. That's because overall, the United States stock market had very low trading volume, and recently, since its vacation season, there have been very few news articles published as well. So, for creators like me who read a lot of articles and provide content to you, it's a bit difficult to work, since there aren't many useful articles to find. So today, just like yesterday, I'll read you another article about Nvidia, because a very important piece of news that could represent Nvidia's future has been reported. Let's go through this article together, and I'll explain in detail what this means for Nvidia's future outlook. Nvidia? There's good news that according to the agreement in September, they completed the acquisition of Intel's shares for $5 billion. All right, first, let's try to grasp the main point of this article. Nvidia completed the process of purchasing Intel's shares on Monday at $23.28 per share, totaling $5 billion. This purchase price is 36% lower than Intel's closing price last Friday. But you'll see later that it wasn't bought at an extremely cheap price. This deal received approval from the United States Federal Trade Commission, the Federal Trade Commission, earlier this month, and then it was finalized yesterday. You can see it that way. Intel's stock price, after the deal was announced, the news first broke in September, has already risen by 45% since then. That's why, even though Intel traded at a level 36% lower than Friday's closing price, it wasn't an excessively low price. You can see it that way. What about this deal? The deal includes a plan to combine Intel's central processing unit chips with Nvidia's industry-leading AI accelerators and install them in Nvidia's AI servers. The Nvidia AI servers mentioned here refer to computers. When we usually talk about data centers, the computers inside them are called AI servers. And to build an AI server, you can't just have a GPU. The AI accelerator mentioned here is the GPU, and next to this AI accelerator, you also need a central processing unit and storage devices. You also need cables to connect all these devices. That's why, when we look at AI beneficiaries, we don't just include companies like Nvidia and AMD that make AI accelerators, but also companies like Micron that make storage devices and companies that make CPUs. Companies like Credo, which provide the cables that connect these devices, can also benefit. This is how we can understand the overall situation. Anyway, this is similar to the role currently played by Nvidia's own Grace Central Processing Unit and the Vera Central Processing Unit, which is scheduled to be released later this year. Now, I'll explain this part in more detail a little later. The two companies also announced that they will integrate Nvidia's graphics technology into Intel's PC chips, which is also something to look forward to. All PCs will now feature artificial intelligence, known as AI PCs, and Nvidia GPUs are very likely to be widely used in them. Intel's integrated graphics have long been pointed out as a chronic weakness among customers. Intel is a powerhouse in CPUs, so many PCs use CPUs made by Intel. Now Intel CPUs and Nvidia's GPUs are coming together as a single package in AI PCs. That's how you can see it. What about this week's stock purchase? While competitors like Nvidia and Taiwan Semiconductor Manufacturing Company are moving ahead, does this provide Intel with the much-needed capital after years of stagnation? Intel, which held a 70% share of the data center equipment market in 2021, has seen its share plummet to just 7% in the most recent quarter. The reason for that is Nvidia. You can see that Intel's market share in the data center equipment market has dropped sharply because it has fallen far behind in the competition with Nvidia. Neither company discussed whether Nvidia would use Intel's struggling foundry to manufacture its own chips. Currently, Taiwan Semiconductor Manufacturing Company is producing all of Nvidia's chips. Intel investors see this deal as a sign of trust gained from Nvidia, the most valuable company in the world. Because of that, Intel's stock price has risen a lot recently. This year, Intel also received investment from the United States Department of Commerce instead of funds from the CHIPS Act and received additional funding from SoftBank. As a result, the stock price has recovered a lot recently. All right, that's all for the discussion about Intel. Now, from here on, I'll share my personal opinion on what this deal means for Nvidia shareholders, what positive impact it could have on Nvidia's stock price in the future. Now, in the article above, Nvidia already has its own Grace and Vera CPUs. So if Nvidia is already producing its own CPUs, why would they want to include Intel CPUs in their AI servers as well? This is something that's bound to make you very curious. But what about this news? Yesterday I told you about Nvidia signing a $20 billion licensing deal with the AI chip startup Grok. In my opinion, it can be interpreted from the same perspective. The article I shared with you yesterday has one main point. Nvidia is no longer just a hardware company that sells GPUs, but is making a lot of effort to become a platform company. That was the most important point. Alright, then let me explain the key points of today's announcement where Nvidia is acquiring Intel's shares. Even though Nvidia already has its own CPUs, Grace and Vera, the decision to combine CPUs into Nvidia's AI servers is significant. It's not just a matter of product selection. I see this as a decision stemming from a long-term platform strategy aimed at dominating the entire AI infrastructure market. Nvidia isn't a central processing unit company. Nvidia is a comprehensive AI platform company that includes GPUs, AI accelerators, and even the Compute Unified Device Architecture software stack. Grace and Vera Central Processing Unit S as well. They weren't developed to directly target the central processing unit market. Grace and Vera. The reason they made CPUs is to maximize the performance of GPUs and to complete a server architecture optimized for AI workloads. You can see it as a strategic supplement. What that means is, from Nvidia's perspective, the central processing unit is not the goal, but rather a means to an end. However, a significant portion of data centers around the world are still operating based on the x86 architecture. x86 is an architecture for making Central Processing Unit S, and the companies using it are Intel and AMD. As you know, the Central Processing Unit market is still dominated by Intel and AMD. Therefore, Nvidia's own Central Processing Unit Grace is based on the Advanced Reduced Instruction Set Computer Machine Architecture, which means it uses a different architecture. What that means is, even though the performance can be excellent, for companies that use existing Intel-based software or infrastructure, switching completely to Advanced Reduced Instruction Set Computer Machine will inevitably incur costs and take time. So, because of these transition costs, it's not easy to make the switch. So from Nvidia's view, by offering bundled products with Intel CPUs, Nvidia's strategy is to make it easier for existing x86 customers to adopt Nvidia's AI accelerator GPUs without any resistance. That's how we can understand it. Let me say it again. When building a server, you can't just have a GPU, you also need a central processing unit. Now, up until now, all the Central Processing Unit S used in data centers have been based on the x86 architecture, so it's difficult to suddenly switch to Grace, which is an Advanced Reduced Instruction Set Computer Machine-based Central Processing Unit. So, in order to reach all customers, from Nvidia's perspective, it's fine if their GPU is connected to their own Grace Central Processing Unit, or if it's connected to the x86 architecture Central Processing Unit, S made by Intel and AMD. You can see it as them making improvements this time. Nvidia keeps Grace as the most ideal option for customers who are hesitant to adopt Grace. By providing the practical alternative of Intel Central Processing Unit S, they're lowering the barrier for Central Processing Unit selection and aiming to accelerate the spread of GPU-centered AI servers. That's how you can see it. So, to put it simply, the key structure is to make sure that no matter what central processing unit is used, NVIDIA is always at the center of AI accelerators. That's how you should see it. Furthermore, this strategy strongly reflects the intention to dominate the standard for AI servers. That's the key point. NVIDIA is saying that instead of insisting on only using their own CPUs, they're open to flexible options. Even CPUs made by Intel are fine. But when it comes to the core structure of AI servers, which consists of GPUs, network, and software stacks, they want to control that part. They're standardizing everything to NVIDIA's criteria, but are only flexible with the central processing unit among server components. They're not giving up, just being more flexible. NVIDIA's goal is to make everything themselves. Now, if it goes like this, server manufacturers and data center customers may be able to change CPUs, but it will inevitably become harder and harder to escape from the NVIDIA ecosystem. In this way, you could say that NVIDIA is essentially taking over the role of the operating system for AI data centers. Now, another important point is the change in Intel's status. In the past, Intel was in a potential competitive relationship with NVIDIA. But as we saw earlier, Intel's market share has weakened so much that it can no longer be considered a competitor. Therefore, since Intel has lost its leadership in the AI accelerator market, from NVIDIA's perspective, Intel is now closer to a useful partner rather than a competitor to beat. So the moment NVIDIA accepts Intel's CPUs, what happens? It can be interpreted positively that this will lower customers' switching costs, accelerate the spread of AI, and ultimately further increase NVIDIA's GPU penetration rate. So the essence of this decision is very clear, isn't it? The reason why NVIDIA chose Intel's central processing unit is, you can see it as part of their bigger plan to completely dominate the AI server and data center market. You know the NVIDIA Grok deal I shared with you yesterday, right? Well, I mentioned that this deal is a sign that NVIDIA is taking its business model to the next level to secure its dominance in the AI era for the long term. The decision to combine Intel's CPUs with NVIDIA's AI servers can be interpreted in the same way. Now, if this strategy of continuously expanding the ecosystem keeps repeating, the market will no longer see NVIDIA as just a GPU company. It will begin to be seen as a platform company setting the standard for AI infrastructure. Here, evaluation means valuation. Stock price is typically earnings times a multiple, but semiconductor and platform companies have very different valuations. For example, Palantir has a very high multiple. The reason is that Palantir is not a hardware company, but a platform company. So if Nvidia transforms from being just a GPU company to becoming a platform company, that means the foundation for its multiple or valuation to increase compared to now will be established. I'll wrap it up like this. You probably felt it while watching the broadcast. My speech still sounds a bit slurred. Like I mentioned yesterday, I have a bump on my tongue, so it hurts quite a bit when I talk. So today I'll try to wrap things up a bit quickly as well. The last content prepared for today is a video about United States stocks. Professor Jeremy Siegel, who works at Wharton School, will appear. So what does Professor Jeremy Siegel have to say? It would be good to check out the dubbed video to see what his outlook is for 2026. That's all for today's Big 2 News on December 30th. I want to thank everyone who stayed with us until the end of today's broadcast. I'll see you tomorrow, December 31st, for the last broadcast of 2025. Let's keep going together until the day we all retire through investing in United States stocks. Have a happy day, and thank you.
Now joining us is Professor Jeremy Siegel, Honorary Professor of Finance at the Wharton School of Business and Chief Economist at Wisdom Tree. It's nice to see you, Professor Siegel. Happy New Year, and I hope you have a wonderful holiday season. Thank you. Over the past year, Professor Siegel, it has been a good time to have a positive outlook on the United States economy. With the strongest economy in the world, the stock market has also enjoyed a favorable environment.
If you look at the gross domestic product figures for the third and fourth quarters, although the final numbers aren't all out yet, just 2 days before Christmas, the Federal Reserve Bank of St. Louis estimated the fourth quarter growth rate at 3%. If you add to that the fact that third quarter gross domestic product exceeded 4%, even though the first quarter was negative. Despite all the disruptions caused by tariffs, the overall growth rate for 2025 is in Joe Biden's last year in office. It's a faster growth rate, setting a new record.
That's clearly the overall economic background, especially for the stock market. I'm not exactly sure if this year's return is 19 or 18, but we can't rule out the possibility that the S&P index could reach 7,000 before the end of the year. That means it could be at least the third or maybe even the fourth very good year. At the very least, it clearly looks like the third good year.
Yes, I agree when I consider next year. Of course, such outlooks have been around for a while because the rise of Magnificent Chabul has been so unprecedented. Next year, the returns of the S&P 500, which has a very high proportion of tech stocks and Magnificent Chabul, may not reach double digits and could remain at a single-digit percentage level. I see, but that's still not a bad figure, is it? Stocks outside the Magnificent Seven could see returns of 10 to 15%. The Magnificent Seven may also gain, but likely only in the low single digits. Of course, it's very difficult to make a one-year forecast, but if this trend appears, it could definitely be a turning point compared to the past 3 years. Nevertheless, 2026 could still lead to a very good market. Overall, there are many positive factors and drivers pushing things forward, but there are also several hurdles in January. One is the potential issue of another government shutdown, and the other is the possibility of an announcement regarding what decision the Supreme Court of the United States will make about tariffs. The president may also announce the next Federal Reserve chair. These are issues that are just as important as indicators like gross domestic product, corporate earnings, and margins, and most of these issues are likely to become clearer in January. The government shutdown issue must be resolved, or a decision on its extension must be made within that month, and the other two matters also seem likely to be announced. So, although there are a few hurdles to overcome, if we get through these processes well, I believe there is a good chance that next year will also be a positive year. That's right.
The S&P 500 Dow's long-term average annual return of 7-8% is often cited as a basic outlook at the year's start. You hear it a lot, right? But in reality, instead of moving exactly in line with that average, there are many years when it rises much more or even ends up falling. Very rarely there are talks predicting a negative annual return, but to be honest, I can't remember the last time someone publicly predicted it would be negative.
Some people do that, but if you make a prediction that's very different from the market consensus, the result is one of two things. You're either completely wrong or you become a hero. Ultimately, deciding to make a prediction is up to you, like saying, let's take a big shot this time. So sometimes there are actually cases where some people make predictions that are very different from the market consensus.
Some have even said this. This approach assumes that the valuation multiple remains at its current level and calculates the upside potential of the S&P 500 based solely on earnings per share growth over the next 12 months. In that case, do you think double-digit returns are possible? What are your thoughts?
In my opinion, under that assumption, a return of around 8 to 10% is definitely possible. As we've seen recently, the growth rate of the Magnificent Seven is slowing down year by year, but their annual growth rate is still in the high teens to low 20s. Since the current price-to-earnings ratio is over 30 times, it's true that valuation compression or multiple contraction is happening. Of course, Tesla's PE is close to 200, so it should be considered separately, but companies like Tesla that are growing at 20% annually are trading at a PE of around 30, and their growth rate is slowing down. Still, I don't call this a bubble, and I'm not predicting that this will last forever, nor am I saying that there won't be any companies that end up disappointing after being hyped up. But What I've been emphasizing is that those who say the current situation is a bubble, or the same as the dot-com bubble in 2000, aren't really looking closely enough at the actual numbers and fundamentals.
Please subscribe to the channel. People grow little by little every day, and maybe a flutter of excitement grows in their hearts. Let go of your greed. I won't lose this time either. The result is just a continuation of the process. And even if a dark adjustment comes, I'm not afraid. I'll hold your hesitant hand and move forward, becoming the light for the unseen tomorrow. Happy investment, Bedal Minjok, that supports each other's dreams. Let's walk together on this beautiful downhill path. Happy investment, together with Miju, we'll all be together until the day we boldly retire with national stock dividends.